It is now time for the big picture. Let's welcome in Kathy Jones, Chief Fixed Income Strategist, Schwab Center for Financial Research, and Joe Mazzola, Head Trading and Derivatives Strategist over at Charles Schwab. Thank you so much for both joining me on this very busy day. Kathy, let's just start with you as far as, I suppose, the positioning ahead of the FOMC decision. We have got the 2-year at about a smidge below 3.5%, the 10-year just below that 4%. So it seems like a similar sort of setup to what we saw pre-last FOMC decision. What are your expectations today?
Yeah, I think along with everyone else, we're expecting a 25 basis point rate cut from the Fed. That has been kind of clearly signaled from Fed Chair Powell, and the worry at the Fed is about the slow growth in employment or a potential rise in unemployment. Of course, we don't have those numbers, so they can only go on the information that they have, but all indications are pointing to a slowdown in the labor market, so that's the key driver. I also am looking to see if there'll be any dissents, because at the last FOMC meeting where we got the dots, there was one member indicating that they thought rates should stay where they were at the last meeting, which would imply that that person would want to hike. And then there were a couple that were looking for steep rate cuts over the next couple of months. So we may see a dissent in either direction, or two dissents, one for higher rates, one for lower rates. It's very, very hard to tell. But that would be a clear indication that we're not really set up for a series of rate cuts necessarily that the market has priced in. So the market is expecting the Fed funds rate to be below 3% by mid-2026. But if you have some dissenting members at this meeting, that would imply there's no consensus about further rate cuts.
Yeah, I mean, I was having a great chat with Terry Wiseman from Macquarie just earlier, and I mean, he was sort of talking about the fact that we could be setting up for what could be, less dovish, maybe even leaning more hawkish because of some of the uncertainties around whether we actually have shoved that inflation genie back firmly in the bottle, and also, where the tariffs are going to land, the US government shutdown, etc. Joe, let's just switch gears to you. We've got about $9 trillion worth of market cap that's going to be hitting the tape this afternoon as far as their report cards. I mean, I'm just looking across the price action right now of the names that are going to be out. We've got Meta lower, Microsoft lower, Google, Alphabet the only one that's higher. What are you expecting later today?
Well, I mean, look, they better deliver. When you're talking about 3 out of the 7 Mag 7, and then 5 overall that are giving earnings this week, it sets up for what could be market-moving events, and here's the reason why. You're talking about 35% of the S&P 500 in terms of their market cap right now. The Mag 7 is projected to deliver about 14% year-over-year earnings per share growth for this quarter. But while that's high, that's actually quite a bit lower. It's almost about 50% lower than what they did in Q2, which is 27% year-over-year growth. So it's going to be interesting to see if there's enough participation overall in the market, because what we've seen recently, Sam, is just kind of a narrowing of that participation. So if we don't see these names deliver, and it's not even just deliver, I think it's really talking about the AI CapEx spend going forward. That's what I think investors will be looking for. But given the fact that we have less than 50% of the market traded above the 50-day moving average, right around 60% above the 200-day, in both the S&P and the Nasdaq is below the 50%, below their 50-day moving average. There's just not a lot of undercurrents below the surface that would help, kind of buttress this market should they not deliver. So, when I see things like that, that just tells me that there's that much more importance on these earnings.
Breadth wasn't great yesterday. I mean, I'm looking at the sectors today. I mean, we're looking at a fairly mixed picture when you look under the hood right now. You and I have spoken extensively about the small cap trade as well. I mean, the Russell 2000 having outperformed more recently, but coming off a little bit right now. I'm just wondering, is today the catalyst for both of those things, breadth and small caps?
Well, it hasn't been the last couple of days. I mean, not even just the percentages above the moving average, but something like advanced decline. I'm looking right now at, we're basically, 2-1 decliners on the S&P 500, and it's about that for the week. So, you can continue to see the markets march higher as we continue to set all-time highs. This is just a continued story of how much AI is driving these markets. It's not just at the spend level, but it's also at what we're seeing from the overall performance.
Okay, we'll be watching a busy day here. Thanks so much for joining me today. Joe Mazzola, Head Trading and Derivatives Strategist at Charles Schwab. And our thanks also to Kathy Jones from the Schwab Center for Financial Research there.